Example, if you go and talk, how do you present number one? Those who know, they hesitate because the market and all those things. The moment you say options, I mean, you have to tell
But you're
directly.
giving excuses, Chinna.
Huh?
You're giving excuses.
No, you tell me, that's what I'm telling you. You give me the presentation, how you tell, not excuses.
I'll give you the presentation.
Right.
Okay? It's like this. What I do,
Right, let me ask you, you impress me first.
What I
Suppose you are
do-
coming to me, yes.
I have a corporate account. So, uh, we, what we do, we invest in the market. We collect premiums. We collect dividends. We're doing level 5 trading. We have balanced accounts.
Oh, yes.
We have income monthly, every month income. We go by percentages. We can make about 3% average a month. And better if I say it and you write it down. Then when I write it, then I won't be saying it because I'll be writing it.
Okay, it's okay, it doesn't matter.
We make like say 3% a month return, give or take. We collect these premiums, and then the advantage is that the people who just have the stock, the people who just own the stock, we're going to be leaps and bounds ahead of them because we're going to be collecting covered calls on all this stuff and over the months and put premiums. So we'll have all that they have plus extra. And then we know how to make money in the down markets. We know how to make money in a bad market. We know how to make money in a sideways market. Most people, they buy an option and the option has to go way up to the sky before they make any money. What we do, we just buy stock and we make the money just like that by selling the options. And hopefully you can learn something with working with us. Maybe a few things I have you like, a few things Shannon has you like. You can take everything you have and we can put it together. We can make some kind of group. So what questions might someone new have?
Very simple. The moment you express stocks, options, bonds, the mutual funds like that,
There's no bonds, there's no mutual funds.
you don't have it.
Mutual fund is for somebody who doesn't know what they're doing. We have our own mutual fund. That's our list of stocks in our balanced account. That's our mutual fund, okay? When you buy a mutual fund, all the person does is they take the money, they buy a bunch of stocks, they do their trading. What they don't tell you is that money from the mutual fund that's made pays the water and power, pays the payroll, pays the sign on the front of the building. Like if they have a bad month, do they go out of business? No, because they use your money for the mutual fund. So instead of giving all them the profit, we don't have any overhead. So we give you back that profit. Also with the mutual fund, they can make 30-40% in 1 year. And then they only have to give you 8% or 9%. That's by law. They can save a lot of that profit for themselves. They don't have to give you. We'll show you. We can show you the trades. We have nothing to hide. We'll show you everything. We'll give you, what you deserve. Bonds? No, I mean bonds. Bonds are like long-term, 30-year, 20-year, 10-year investment. We don't really do trading, so I don't do bond trading. There's plenty of bond people out there who want to do bonds. I know a little about bonds, but I know enough that it's not going to give you the monthly income that stocks can give you. So we just do stocks, mostly.
Okay, if they ask what is your performance, how do you prove?
Well, you can't prove anything, okay? The proof is in the pudding, okay? We'll show them what we're doing. We can take them to City Waterhouse. They get comfortable. They sit down. We can show them what we're doing. We can have them talk to the brokers. And we're going to actually manage the money. We're going to have complete access to the money. And we can do the trades and do everything. And then they can see it. But they'll get a statement every month. They'll get a statement. They get when they deposit money with us, they'll get a notarized document saying you deposited this money with us, and they get notarized. Okay, that's your receipt. Then every month we'll give them a statement. What are we investing in? What was our return? Like that. You might have, 1 or 2 months where you lose a few percent. It's okay, but you always have that premium. The premium comes in. We're selling calls. We're selling puts. The premium always comes in on top of whatever the market does. And then if we're in the better positions, which we know how to do, we're going to outperform the market. So we're going to outperform the market in our position. Plus, we're going to get premium. That's the theory. That's the ideal situation. That's what we do.
So how do you do now, for example, this is a separate entity who manages?
Manage. The corporation will take the money, and Shannon and Eric do all the trades. Shannon and Eric manage the money.
Right, suppose if there is X, there's Y, there is Z. How do they put? Is it in the ratio? Is it in the form of equity? Or is it like $1,000 a unit or 5,000 unit? How is that?
It's none of that. You know the portfolio letter? You know the portfolio, 100K? 100K portfolio?
No, that's 100K portfolio.
I'm asking you, do you know the paper? The account's going to look something like that. Right? We'll put their money on that portfolio. If they only have 50,000, then we'll put it. If they have $1 million, then we'll put it. Right? Maybe
Wait,
$1 million. Wait. Maybe $1
individual.
million, you'll have a little more positions. Okay. Maybe the cash instead of 10% will be 15% because we can. But Shannon and I will do the trades. It's out of the corporate account, and depending on what they want, we can pay them like a salary monthly on the returns, or we can let the account build up however they want. There should be a couple options. Option one, everything in the account, let it build up. Option two, they can take payments of cash or checks based on the return at the end of the month, like that. Whatever they want. Option three, 50-50. Put 50, whatever we make, put 50% in the account, 50% they get cash out. A lot of people want? They want income, they want cash, they want to make money, they want to see the money in this bad market. So it's better.
Not even bad. Now I understand.
Let me explain. So what I would like to do, so we take $1 million, right? Let's make 1%, which is 10,000. Let's pay them that. See, I can do just on puts and calls. I can make like 3% just on the premiums. So let me do that, and then 1% goes back to the person. They get 10,000. The other percent goes to the account to build up, and let it fluctuate 1 or 2%. It's going to happen. We wanna under promise and over deliver. Just like the vitamins, remember? Take these vitamins. You're gonna do backflips in 5 minutes. Believe me, take them. Give me the money and you take them. And when they take the vitamins, they go, well, I don't feel any different. They get upset because you promise them too much. So, under promise and over deliver. Give yourself a chance to make them happy. If you tell them you're gonna make them 5% and you make 3%, they're gonna be upset. So we should tell them we can make 3%. We'll give you 1%, and then whatever else we get, we can build to the account. And the account will fluctuate 1 to 2% a month. You have all of your positions. You can have some shorts, some longs, some straddles, some puts, some dividends, some covered calls, spreads. You make it so we make the account so you really can't lose too much money. The market goes up one way, we're making money here. Market goes down one way, we're making money here. The premiums will raise everything up. Will give us the profit.
That's one.
Selling options.
Okay, that's one individual.